All right, today we're going to be talking about Chapter 2. And before we get into that, I wanted to point out that I'm wearing my DECA shirt to remind me to talk to you a little bit quickly about DECA. DECA is a student organization, student run, that I am the advisor for, and it is an organization that we compete and do a lot of things. If you're a business major, we do a lot of case studies where we compete and present ideas for marketing, management, accounting, finance. I said management. Anyway, just a bunch of different areas. Plus, if you're interested in the stock market, we do a stock market game. We also have guest speakers and things like that to come in. It's a really great organization, and I highly recommend that you really give strong consideration to it. So please consider that if you haven't already. So today we're going to be talking about analyzing and recording transactions. We talked about this a little bit in Chapter 1, but our focus was primarily about the accounting equation. But we're going to go ahead and we're going to be introducing some new areas in this to kind of make it a little bit more accounting wise. Yes, you're the accounting. Okay. All right, so what we're going to learn today in this video is talking about an account, what it's used for. Basically, we're going to be learning about what is an asset, liability, equity, revenue, expense, withdrawals, things like that. We're also going to be talking about double entry accounting, debits and credits. Okay, that's something that's very important. And then we're going to go ahead and continue to evaluate and analyze transactions, as well as doing our financial statement and creating those financial statements from a trial balance. All right, so let's talk about the accounts and their use. All right, let's go ahead and go through some of these. But first, let's go through basic financial statements, or let's just skip that until we get here. So when we have a transaction, we have to have a source document. Examples of source documents are going to be bills, checks, bank statements, pretty much anything that you can get tangibly. It could be an email. It could be anything that just basically identifies that a transaction has occurred. What we're going to do is we're going to take those source documents and we're going to identify the accounts that we need to record them, just like we did in Chapter 1, and then we're going to put them into the general journal, which will then, when we post them, we'll put them into the general ledger. All right, so here's some examples of some assets, liabilities, and equity. I think we got some better slides here, so we're just going to move to these. Asset accounts is pretty much anything tangible or intangible that is going to give a benefit to you in the future, okay? If you have cash in and of itself doesn't do anything, but your use of cash, future benefit. Accounts receivable, that's when your customers owe you money. Notes receivable, that's when you've lent out money and people owe you money. Prepaid accounts, for example, if you've prepaid electric bills or something else, that is a prepaid account, and then they reduce that amount for you as you use it. Supplies, equipment, building, land, all these are asset type accounts. Then you have liability accounts. You have your accounts payable, notes payable. Pretty much anything that says payable is going to be your buzzword for a liability. Just like receivable for assets, you're going to have payable for liabilities. Those are your buzzwords. So accounts payable, salaries payable, tax payable, notes payable, payable. Unearned is also a buzzword. Unearned means you haven't earned it yet, which means if you've gotten paid in advance for something you haven't done yet. So that's an unearned revenue, okay? And accrued liabilities are liabilities that you have used, expenses you've used but have not yet paid for. All right, so for example, if a company has used some of their employees' labor, they owe them that money, but they haven't paid it yet. Kind of like, you know how you work 2 weeks and then it's the third week you get that check? For those 2 weeks that you worked, when they're processing it, that's a liability until they pay you. That's the concept there. And we'll get into more of that in Chapter 3. Equity accounts are your owner's capital, owner's withdrawals, revenues, and expenses. We talked about this in Chapter 1. Remember that an increase to owner's withdrawals or expenses will be an overall decrease to our equity account. Owner's capital and revenues are both going to increase the owner's equity as they increase. All right, so here's our expended equity. Again, remember owner's capital minus owner's withdrawals plus revenues minus expenses. You should be familiar with that. In many companies, you're going to see what's called a chart of accounts. All right, a chart of accounts is a listing of all the accounts and their number that is listed as part of their system. Okay, there are no account balances. There's nothing else in there. It is just the accounts and their account number. So cash would be 101. Typically, in most companies, 99% of the time, cash is going to be the first listed asset at 101, and then everything else. Notice that all assets are listed as 100, liabilities are listed as 200, and equities are listed. The equity itself is listed as 300s, revenues as 400s, and expenses as 600s. This is a common practice, all right? If you pull anyone's chart of accounts, if you go through and see these numbers, you're more than likely going to be able to identify what kind of an account it is. Now, let's talk a little bit about debits and credits, all right? Debits, for example. Debits are, you get that little card from your bank, what do they call it? Yeah, they call it a debit card. It's not a debit card. It's a bank card or a check card. Basically, that card was created to eliminate the need for checks, right? It didn't, but at the same time, you still have it, and it still represents that. Whoever decided to call it a debit card, I would like to find them and have a quick accounting talk with them because they've screwed a lot of things up. A debit does not mean you are reducing your bank account. A debit doesn't even mean you're reducing anything. It is simply and wholeheartedly just the left side of a T account or the first entry of a journal entry. That's it. Same thing with the credit. You're familiar with the credit card, but it doesn't mean anything. It doesn't mean you owe somebody money. It just means it's the right side of a T account or the second or last account you list on a journal entry. Now, let me explain a little bit this to you. When we look, this is what is called a T account. We have our account title here. And in accounting, you're going to learn, we don't make this stuff up. We don't call this the perpendicular account of blessing, like a marketing person would come. They come up with some creative name that's everyone, oh, that's so cute. No, it's a shape of a T. It's a T account. That's what we do as accountants, all right? The left side of this T account is a debit, no matter what. The right side is a credit, no matter what. Debit's on the left, credit's on the right. That's how it is. Doesn't matter what kind of an account it is. Asset, liability, equity, revenue, or expense, does not matter. It is the left side is a debit, the right side is a credit. And hopefully you kind of understand that concept. So for double entry accounting, what we need to do is we need to have, when we do a journal entry, is we need to have at least one debit and at least one credit that equal in their totals to keep us in balance, all right? So look at this. This is a great slide for you to look at, but I'm going to actually skip to the next slide because it's more accurate, more what we want. When we look at assets here, we're looking at debits are what's going to increase it. That's what this plus is. If you pause this video right now and write all these down, and every time you're doing homework or tests or anything else that you're allowed to use notes for, you need to have this on there, all right? You need to have this as your as something to reference. So you have increase for your debits as for assets, and a credit will decrease that asset, okay? Liabilities, it's opposite, all right? You decrease on a debit and you increase for a credit. Notice that every time you see a positive, the word normal is underneath it. That means whatever increases that balance is its normal balance. More likely than not, you will not see a balance of a credit on withdrawals. Why? Because that's technically an owner contribution. You will never see a credit balance in expenses because that's technically a revenue. So you'll never see these outside the normal balance. Yes, there's always exceptions, but we're not talking about the exceptions right now. This is the rule that I want you to learn and focus on. Owner's capital increases with the credit, decreases with the debit. Same with revenues. Withdrawals and expenses do a lot like what the assets do. Increase for debits and decrease for credits, okay? All right, so here is our, I think this spans from chapter 1, because I remember that owner withdrawal of $200, which was hardly anything. But these were all of the cash transactions, all right? On the left-hand side on our cash, we see that we received the investment by the owner for $30,000. We see that we received $4,200 for revenue, and then we received $1,900 in a collection of our accounts receivable. So that equals $36,100, excuse me. Then on the right side, we see all the expenditures for cash, okay? So all the expenditures are going to be a credit. All the reductions to cash are on the right side, and all of the increases are going to be on the left side. Debits on the left, credits on the right. Normal balance for an asset is a debit, and we have a $4,800 balance in the cash account. Some people like to ask me, Brian, can we have a credit balance on the cash account? No, because a credit balance on the cash account represents that you overpaid for something, and if you're holding this at a bank, you now owe that bank money. So now that's an account payable. You owe one of your vendors, or a note payable. You owe one of your banks or notes or vendors or whatever some money. So that's no longer a cash. You just zero it out, and the difference would be put as a payable, as a liability. All right, so let's look and see how they have the impact on the financial statements, these transactions. Remember, we're going to identify the transactions, analyze it, record the journal entry, and then post it to the ledger, okay? So let's look at this. This is what a journal looks like when I use column or paper. I wish I had some with me. I always say that too when I go over this chapter. But you can see here, this is what it looks like, but basically it's formatted this way. I want you to notice, though, that all debits are listed first. Don't list credits first. Credits are indented. You push the indentation here, and then the credit on this side. It's an easier way to find transactions when you're looking for them, okay? All right. And then this is the general ledger, okay? General ledger holds all of the accounts and their balances in it, all right? So cash has a balance of 5,700 is the debit balance in this particular one. This one doesn't look like it's, no, it does look like it's the same. It just doesn't show all of the transactions. When we post them, we're posting our general journal information that we've recorded, and we put them into their ledger accounts. Today's society, today's world, it's just a simple hitting enter and it posts it for you electronically. But you need to understand what it's doing when you put these journal entries in there. You are assigning them to different accounts and the balances and the amounts they're going to. All right, so here we go. Let's go ahead and look at some transactions, okay? This is going back now through the prior transactions from Chapter 1. Fast Forward receives $30,000 from Chaz Taylor as an owner investment. So we see here, are analyzing it using the accounting equation that cash increased and so did equity. Well, what increases cash? Well, cash is an asset, so debits will increase it. So we're going to debit cash for $30,000. Well, we're also dealing with the C. Taylor Capital. What increases the capital account? In this particular case, the owner's contributions, a credit's going to increase it. So we're going to credit that for $30,000. So we see we have a debit for $30,000 and a credit for $30,000, and they both still equal in the accounting equation, so we're still good. That's what we want to look for, okay? Transaction 2, if you'll remember again, we had our cash increase with supplies but decrease in cash. So what do we do to decrease cash? We credit it, and then we debit the supplies. This is how we can make this happen. So you see, we're basically just replacing the minus and the plus with debit and credit when we're dealing with the assets. We're saying we're debiting or crediting the cash and debiting the supplies by $2,500. And then we post them. When we post them from our journal entries, we simulate that by putting them into our T accounts, and it helps us out, keeps things straight. Same thing with equipment here, processing this transaction, cash $26,000 is going out. So it is a credit, and $26,000 worth of equipment is coming in. Okay. Supplies is increasing, but so is our liability. So we're debiting supplies $7,100 and crediting accounts payable $7,100. Remember again, I want to point this out. We're debiting supplies here. It's listed first. We're crediting accounts payable. It's listed second. It's indented, and it's listed as a credit, and we post them to their respective T accounts. All right, so we did work and got $4,200 cash. So our revenue increases, and so does our cash. Credit increases our revenue, so we're going to see a credit of $4,200 to show that we got that much of revenue, and $4,200 of cash is increasing, so we're going to debit that. You can kind of see how this, once you can translate what it means from the accounting equation to debits and credits, you're going to be doing really good. But if you find that you're struggling with this, don't get discouraged because it's normal, all right? It's kind of a different language. It's a different concept. So don't get too flustered if this occurs, and stay focused and just do your best. And come to me. Ask for help early and often. It is not a sign of weakness if you are um, asking me for help. It is not a sign of weakness. It is a sign of strength to recognize that you need help. Okay, I need help. We all need help. All right. We're paying rent for $1,000, so our rent expense normal balance is a debit. So we're going to increase rent expense by 1,000, and we're going to decrease cash, which its balance then goes down, and that is a credit to do that. We're kind of going fast through these transactions because they should have been familiar to you from chapter 1. If you are trying to watch this now, I know I'm on transaction number 7. I'm telling you this now, but if you haven't watched the video for chapter 1 and you're struggling right now with this, you need to go back, watch some of the snippets if you want to watch just the transactions and go through those. But this is a pretty fast-paced one because it really, all this is doing is demonstrating the debits and credit concept here. So again, another expense. We increase our expense by $700 by debiting it, and we increase cash, decrease cash by $700, and we do a credit to that. All right, we receive consulting revenue and rental revenue. So our accounts receivable, but we're not getting the cash for it. So we're going to increase our account receivable. It's basically they owe us money, and we're going to say, hey, we got it. You owe us this $1,900. So we're going to show a $1,600 increase in consulting revenue and a $300 increase in rental revenue. It's pretty cheap. It must be like just a closet or something in our place for $300. And this was done in 2021, so whatever. All right. Now we receive some of that money, or all that money, from our accounts receivable. You remember we don't deal anything with revenues at this point because we've already booked them. We've already recorded them. We don't need to do it again. All we're doing is moving it from what they owe us. They don't owe it to us anymore. Now we're putting it into cash, okay, because we've received the cash. All right. Now we're going to make a partial payment toward our accounts payable. We owe $7,100. So we're going to pay $900 to that. So we're going to debit the accounts payable because we're reducing accounts payable. We're going to credit the cash, $900, because we're reducing the cash. And then we withdraw the money from our company, or the owner does. So we're going to increase the withdrawals account by $200, which is an overall decrease to equity. And then we're going to decrease cash. Okay? Receipt of, they're throwing in a new one for us. All right, receipt of cash for future services. So let's say that we received money that we haven't done yet for the work we haven't done. So we're going to get $3,000 cash. That's going to go up. But now we're recording unearned consulting revenue of $3,000. It's a liability. We haven't earned it. So we're going to debit cash by $3,000 and credit unearned consulting revenue for $3,000. We owe that money if we don't do that work. And then what if we prepay some of our insurance? So we pay $2,400 for a 24-month insurance policy, $100 a month, basically. I think we do this somewhere like in November or something like that, but it doesn't say here. So we're going to debit our asset of prepaid insurance for $2,400 and credit our asset of cash for $2,400. We're basically turning our cash into a prepaid account. And then we purchase supplies for account. Or for cash, excuse me. We're increasing supplies, decreasing cash. We've done that before. Debit supplies, credit cash for $120, and then post them. Payment of expenses in cash. We're paying utilities for December, $305. So we're decreasing cash, and we're decreasing equity, but it's going to be an increase to the utilities expense account by $305 to debit that, and we're crediting cash for $305. Paying for more work performed by our employees, $700. Decrease cash, $700. Decrease equity by $700 under salaries expense. But salaries expense is increasing to reflect how much we paid. So we're going to debit $700. That's its normal balance. And credit cash, $700. It's going down. So here is all of the T accounts now posted to all the accounts we did in the general journal as they look like posted to the general ledger. So the general ledger is going to show me that I have a cash account and its balance is $4,275. It's a debit balance. Account receivable has a zero balance. Supplies has a $9,720 balance, et cetera, on through all of these accounts. This is the general ledger, and this is why we say general ledger has all the accounts and their balances. Okay. So now what we need to do is we need to create the financial statements from the trial balance. A trial balance is basically putting all of the accounts that we were just looking at into an organized format so that we can evaluate it and create our financial statement. Well, a trial balance is going to show all the debits and credits. Our debits and credits must equal. If they don't, we got to go back and look and see where we went wrong. And I guarantee you we did something wrong. So all of our debits are listed, all of our credits are listed. We see that we balance. Notice here again that we have our revenues and expenses at the bottom. We have our capital accounts here, and then our liabilities, and then our assets. It's always listed this way: assets, liabilities, equity, revenue, expense, all the way down the trial balance. Okay. So, searching for errors. If you ever find an error, you just basically you go back each step until you find it. So if you're at the trial balance, go back and look and make sure you posted them to the ledger correctly and added up all those balances correctly. If you found the error, great, move on. If you didn't, then you need to go back to the journal entries and go through all those. And then if you don't find it there, you got to, go to the source documents. So financial statements, okay? The income statement, the statement of owner's equity, and the cash flow is going to show you what happened over the accounting period. But the beginning balance and the ending balance of the balance sheet shows you where we were at one point in time, each of those times, usually December 31st of the year. The income statement, again, reports revenues minus expenses. That gives you your net income or net loss. Statement of owner's equity reports changes in your equity over whatever accounting period we're doing. We add in any owner contributions, we add it to the beginning balance, and then we add in net income and subtract out any owner withdrawals. The balance sheet lists everything else that we didn't put on the income statement or the statement of owner's equity. And again, I want to emphasize that we do not worry about the statement of cash flows in accounting 111. We will do that in 112. All right, so here we go, income statement. We have our consulting revenue. We put it on here. We got $6,100. We show our expenses. We have a net income of $33.95. Okay. Then we go to our statement of owner's equity. Notice our that's the income statement still. I'm like, wait, what is this? Whoops, nope, back up. Notice we have a 0 at the beginning because we just started the company. It's December 31st. All of our investments by the owner, that $30,000 that we started with is there. Then our net income's added to it, and we subtract out our withdrawal. So our equity is $33,195. We put that $33,195 here as the equity. We list everything else we had, all of our assets and liabilities, and we should equal up the same amount that was on our trial balance, okay? Dollar signs are not used. These are just some kind of formatting situations. Look over here. You only put the dollar sign in the first one. I put it on all of them most of the time. It's not good practice, but I do it anyway. Whoops. And then in the totals, it's just, it really there's formatting situations that you have to follow for GAAP, but I don't focus on that or anything else. Okay, this last part is doing the debt to equity. The debt ratio, not the debt to equity. And this is more kind of an FYI. You may have a couple questions on the quiz because it's a bunch of questions that could be pulled. So you want to know it, but basically just take your total liabilities divided by your total assets. All right. The higher this number is, the more liabilities you have in relationship to your total assets. So you want to make sure that as a company that you're going to keep that at a rate that's pretty decent. Maybe somewhere between 40 and 60% is probably a good place to keep that. So, and then as we look at Costco and Walmart, we can see that their debt ratios at are pretty comparable, but Costco's is going down while Walmart's is increasing. So what's going on? Why is there we see that well, we don't have Walmart's data for some reason. I think that's just Costco's. But we see that Costco's total assets are increasing, even though their liabilities are also increasing, but their assets are increasing at a higher rate. So maybe they're using a lot more cash than Walmart is. So just something to look at and to consider and think about. You do want to know this calculation But that's about it. Interpretation, we'll start learning how to do that in accounting 112. Anyway, that's chapter 2. And before I forget again, your word is century, Century. Again, that word is century, Century. For those of you military or police type, it's going to be Charlie Echo November Tango Umbrella Romeo Yankee is how you spell that. Please don't spell all those out when you put it into the quiz, otherwise it'll fry it. No, I'm just kidding. You won't get the points. Anyway, hey guys, we'll see you in chapter 2. Let me just prove to you that yes, we're at the end of chapter 2. We'll see you in chapter 3. Okay. Good luck. Get your homework done, and let me know if you have any questions.